So after checking out on the US tax filing issue here, so let's follow Rex Low, our second speaker, to review some of the tax items in Hong Kong. Rex is a senior tax manager from the EY Hong Kong tax practice and is currently based in EY's New York office. He heads up the Hong Kong tax desk. So Rex has over 10 years of experience in Hong Kong tax and business advisories area. And he also assists various Hong Kong and China-based clients on their outbound investment in the US and Europe with tax advice on their investment structure. So in the next 15 minutes, Rex will take us back now to Hong Kong and review some tax item and impact, and with comparison to other popular country for immigration and pre-immigration planning, such as Australia, Canada, and UK. So let's welcome Rex.
Thanks, Harriet. Hey, everyone, good evening, and good morning to our audience from Hong Kong. Thanks so much for joining us today. As Harriet just mentioned, I'm the Hong Kong desk in EY New York office. Perhaps some of you are curious about my role and what I do here. I'm not going to spend much time to introduce myself. Briefly speaking, my daily work here is to advise the US company about setting up business in Hong Kong and using Hong Kong structure for tax planning purpose. So in the past, I was participated in many events to talk about how good the Hong Kong tax system is and encourage my client to come to Hong Kong. However, today, I'm not going to talk about coming to Hong Kong. The topic for today is about immigration from Hong Kong to other locations. So when we decide to talk about this issue, I think it's a bit challenging. Because on one hand, I want to tell you Hong Kong is a good place. But at the same time, I'm going to discuss with you your plan to leave the city. I'm just kidding. But it's always true to say Hong Kong is an attractive place. So on the next slide, if you look at the table on the screen, you will understand why. If you work in Hong Kong, you only have to pay 15% of your income as the salaries tax, which is less than half of the other jurisdictions. Then for companies in Hong Kong, the corporate tax rate is only 16.5%, which is relatively low if you compare to other jurisdictions. And even you decide to exit from Hong Kong, the Hong Kong government will not charge you any tax on capital gain. And one of the key points I want to highlight is the taxation principle. As you can see in the first row, Hong Kong tax is on territorial basis, while most of the other jurisdictions adopt worldwide basis. What does it mean? Briefly speaking, as a Hong Kong resident, you only have to pay tax for the income generated in Hong Kong. For example, if you own a property outside Hong Kong, the rental income you receive is not taxable in Hong Kong because such income will be regarded as non-Hong Kong source income. But in many other jurisdictions, income is taxable on worldwide basis. One example is United States. As Brian just mentioned, if you are a green card holder, even your income is from Hong Kong, you may still be subject to tax in US. Because of such taxation principle, tax planning should be done before immigration to those countries. And that's why I'm here today to share with you. After this session, perhaps you may have some questions about the tax rule in those jurisdictions. Bear with me if some of them are outside my area of expertise. But you are most welcome to send us your questions. Because in my team, there are many tax experts from different countries, and I'm sure I can find the best resources to help you. Okay, let's move on to the next slide. Thank you. Today's topic is about immigration. Before going to enjoy your new life in another countries, of course, you have to make a lot of planning, right? Pre-immigration tax planning is one of the things you should do. I understand UK is one of the most popular locations considered by many Hong Kong people. So my presentation will be focusing on UK. As mentioned before, UK adopts worldwide basis. So non-UK income generated by a UK tax resident may also be taxable in UK. But when we talk about UK tax resident, we need to know the difference between domicile tax resident and non-domicile tax resident. Perhaps some of you may think these terms are quite confusing. You may say, well, as I have already moved to UK, why do I still be regarded as non-domicile? Actually, tax resident and domicile are different concepts. Briefly speaking, tax resident is a short-term concept. It mainly represents the location where you reside during a period, while domicile is more a long-term concept. It refers to the location where you are going to have your permanent home over the course of your life. For example, you can retain a domicile in Hong Kong, even if you live in UK for a number of years. From tax perspective, it's important to identify whether you are a domicile tax resident or a non-domicile tax resident. If you are a domicile tax resident, your income outside UK will also be taxable in UK, even though the money is not remitted to UK. But if you are a non-domicile tax resident, there would be some tax planning opportunity. Because as a non-domicile tax resident, you can elect remittance-based taxation. With such taxation election, non-UK income is not taxable if they are not remitted to UK. But some of you may say, hey, I need to spend money in UK, so I can't just keep all those money in Hong Kong. No worries. As long as the income was generated before you become a UK resident, it will not be taxable, even if the money is remitted to UK. Therefore, we call the pre-immigration income as clean capital. Here, I want to give you a very important message. The clean capital must be segregated from the income arising after you become a UK tax resident. Because if the clean capital is mixed with the post-immigration income, when you remit those money in the future, you may not be able to support the amount was derived before your immigration, and therefore the tax authority may disallow your non-taxable claim. To segregate the clean capital, the most common practice is using a separate bank account to hold the pre-immigration income and make sure your post-immigration income will not be transferred to the same bank account. Okay, on the next page, I'm going to talk about securities trading. We all know many Hong Kong people are very keen on speculating in the stock market or making some financial investment. Actually, the tax system in Hong Kong are quite generous to the investor because in Hong Kong, we do not have any tax on capital gain. So normally your income from the stock market are not subject to tax in Hong Kong. Unfortunately, it's not the case in many other jurisdictions. In many countries, you have to pay capital gain tax on your income from securities trading. As discussed earlier, UK adopt worldwide basis. And once you have become a UK tax resident, your income from securities trading in the Hong Kong stock market will also be subject to a capital gain tax in UK. So it's important for us to understand how the capital gain is calculated. In UK, capital gain equals to the difference between sales proceed and the cost of acquisition. For easy reference, I illustrate the mechanism by this diagram. For example, let's say today you purchase some shares from the Hong Kong stock market at 5 million. And assuming 2 years later, you will move to UK and become a UK tax resident. And at that time, the market value of the shares has been increased to 7 million. And then the stocks continue to perform very strongly after your immigration. So let's say 5 years later, the price is increased to 10 million. And then you decide to sell it. Under this scenario, your capital gain is equal to 5 million, which is equal to the difference between the sales proceed, 10 million, and the purchase price. Now let's look at the second scenario. In this scenario, you also purchase the shares at 5 million today. And I assume 2 years later, you will also become a UK tax resident. And at that time, the market value of the shares is also increased to 7 million. But the difference is, in the second scenario, you will sell the shares and realize the gain before immigration. As discussed before, capital gain is not taxable in Hong Kong. And the income you derive before you become a UK tax resident should not be taxable in UK as well. In other words, the 2 million investment gain realized before immigration would not be subject to tax in any jurisdiction. But some of you may say, I expect the shares will continue to perform very strongly, and I really want to hold the stock. No worries, you can repurchase it immediately after disposal. For example, 5 years later, when you sell the share at 10 million, then only 3 million will be subject to tax in UK, because the cost of investment under this scenario is 7 million. So when people tell you before immigration to UK, you should rebase the assets by sales and repurchase, they are actually talking about this method to step up the cost base of any capital gain in the future. Okay, for UK, we can reduce the cost base by sales and repurchase. Then how about other jurisdictions? On the next page, we will show you how capital gain is calculated in Australia and Canada. Unlike UK, the cost base of capital gain in Australia and Canada equals to market value at the point of immigration rather than the cost of purchase. So if you move to Australia and Canada, you don't have to step up the cost. And yeah, so unlike UK, you don't have to step up the cost for any future capital gain tax. But it's important for you to keep the document to support the fair market value at the point of your immigration. So in case the tax authority asks you for some supporting document to support the value of your immigration time, then you can provide it to the tax authority. On the last page, I will briefly talk about some factors you should consider for holding UK properties. To be honest, it's quite hard to say which holding structure is the best, because some people may want to hold the properties by using some company or trust, and some of them may prefer holding it by himself. But I would like to highlight some factors that you should consider. The first factor you should consider, of course, is the tax rate. Because in UK, the individual income tax, the maximum rate could be 45%. If the maximum rate is applicable to you, then you may consider using a company to hold the properties, because the tax rate for company which receives the rental income is only 19%. And similarly, in the future, if you sell the properties under the individual tax system, the maximum amount of tax could be 28%. But for company, the tax rate is only 19%. So when you design the holding structure, the key thing you should consider should be the tax rate. But besides that, in UK, the tax system also have a tax called ATED. The full name is Annual Tax on Envelope Jewelry. This tax is only applicable to company, but this tax is not applicable to individual. So when you decide the holding structure, the first thing you should consider is your purpose of holding the company, and secondly, you should consider the tax rates. And besides tax, maybe you should also consider your cost of setting up the company and also the cost of maintaining the company. So that's all the tax planning idea I would like to share with you today. Perhaps you may have some questions on that. So here, let me hand over to Harriet again to see what's your questions. Yeah.
Thank you, Rex. That is very informative too. And we are glad to know that we have choices, isn't it? Not only US, you also mentioned about other country, and your comparison of the tax item. Sure, I believe that our audience should include that on their pre-immigration checklist so they can consider and think through it before they make a choice. But during your talk, I do have one question about, you mentioned about the capital gain tax is basically is tax-free in Hong Kong, but then it's subject to it in other countries. So we talk about the stock and rebasing it. How about for most of the people that I know from Hong Kong, where I came from too, so people will probably sell their properties before they exit Hong Kong and migrate to other countries. So from that point, for that capital gain tax on the property, would that be applicable, or would that be other tax like the stamp tax?
Right, that's a very good question, because when the people sell the properties, they would likely derive a gain. And as I said, capital gain is not taxable in Hong Kong. However, you may ask how to determine the nature of the gain. For example, whether the gain should be regarded as capital in nature, which is not taxable in Hong Kong, or it would be regarded as trading in nature. The tax law in Hong Kong does not have a very clear guideline about how to determine the nature of the income. But according to some tax cases and the practice law issued by the Hong Kong Tax Authority, basically, the key factor to be considered by the Hong Kong Tax Authority is the intention of holding those properties. For example, if an individual holds the properties for a very long period and he does not have any other similar transaction of properties, then usually the tax authority would accept that the intention of that person to hold the properties is not for trading purpose, and therefore any gain should be regarded as capital in nature and not subject to tax in Hong Kong. But on the other hand, let's say if an individual or a company hold more than 10 properties in Hong Kong, and he has those transactions every month, and also after he purchased the properties, he only hold the properties for, let's say, a few months. Then the Hong Kong Tax Authority may take the position that this guy hold the properties for trading purpose, and therefore the gain derived by him would not be regarded as capital in nature, and therefore it would be subject to the profit tax in Hong Kong. Yeah, before most people, before the immigration, if they sell the properties, usually the tax authority would not deem the income as taxable in Hong Kong.
I see. Thank you, Rex. Thank you.